Welcome to Yellow Tunnel. My name is Lacarpella. I'm CEO and founder of Yellow Tunnel, and today we're going to have our live webinar where we talk about current market conditions and answer any questions you might have about your subscription. I'll like this. For those of you who are new, welcome. This is my brief bio. For those of you who are new, and disclosures are also very important. Please read them. If you're new to trading, you can visit optionstrading.com so you can understand the risk associated with trading stock or options. All right, before we jump into trading psychology, let's talk about current market conditions. Market did pull back aggressively, so let's take a look. This is aggressive power trader model, one of our main models. It basically shows the predictions for spiders. You can also, type in any symbols like NVIDIA, and it will show you predictions. For the next 10 days, potentially reaching 100 level on NVIDIA. But going into Q2 in the next couple of months, retracing back to 124, or maybe as high as close to 130 level. So that's you have a 10-day prediction, you have long-term predictions, and then key support and resistance levels. If you look at the spiders, it does see for the next 10 days 500 level. I think 500 is a pretty aggressive, sharp drop, which I don't think is going to happen, but it shows you that the trend is to the downside. Trend is to the downside for short term. Long term, it still sees that we can retrace back to 591 and 600. So both plausible scenarios, right? So we could drop, another 5–10%, or we can rally back to close to all-time highs, and that's the current setup in the market. So let's take a look at some of the information to see where we think the market can go. So in terms of yield, if you look at the yield, we're pegged at the 4.3%, right? So yield did drop significantly, which is bullish for the market, right? Everybody was afraid of inflation. We had better than expected CPI data, and yield is stable at 4.3%. Sharp drop in dollar. We reached 110 on fears of tariffs, and that will be net inflationary. And now this whole fear got reversed back to 103. So that's also bullish for the market. I think weaker dollar in general is bullish for the market. Very sharp pullback, right? We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 sessions without any reprieve, right? You haven't seen such a sharp pullback probably since 22, when the rates were originally potentially lowering. So, and it did break July high overhead resistance. So below 200-day moving average, a drop of about, I think last time I checked, close to 15%, 14%. For QQQ, similar value stocks, about 10% pullback, right? So in correction territory, 7% so far, but close to 10%. And then spiders are, I think, exactly 10% from the highs. Yeah, 10%, almost to the penny, 10% pullback. Small caps are close to bear market, right? Almost, I think, 20% pullback. Yeah, so almost 20% pullback in small caps, right? Very sensitive to fears of recession. Smaller balance sheet, so you can see, and same thing with high beta stock like Arc Innovation is down 30%, down 30%. High beta stocks like Tesla is one of them, is down close to 30%. So the question is, what's next? Can you make a bull case? Can you make a bear case? So let's go through different scenarios, right? I mean, one thing you can say that nobody knows for sure exactly what the next move in the market. You know, we could, just like the model says, we could be down, you know, 500, I think exaggeration, but we could be down to 530, 540, right? Depending on the macroeconomic news, right? I think there's two things that have to happen in order for the market to rebound right now. One is the Trump administration to back off at least a little bit from the tariffs, right? From that rhetoric of 20% across the board on, you know, Canada, Mexico, European Union, right? For now, he's selective, maybe copper, maybe you know, aluminum, steel, and European Union and Canada is reciprocating with the tariffs. And then beginning of April 4th, the plan is to kind of tit for tat, kind of reciprocal tariffs to kind of bring the imports and exports into the balance. If the new administration doesn't back off from that planning, then we could see 500, 520, right? We could see 500, 520. But on the same hand, you know, if they do back off from the tariffs, or the Fed will start hinting that, you know, they don't need to be in wait and see mode, they're going to start lowering interest rates, right? Because that's one of the goals of new administration is to have lower interest rates. So if Powell says we're not going to be in wait and see mode and we're penciling in, you know, maybe, you know, 3 or 4 rate cuts, right? So I think those are the two things that potentially can bring the market back. So let's make a bull case. You know, one thing that I do like, if you look at the percent of stocks above 20-day moving average, right? This is a kind of a contrarian chart. A lot of people like this chart, 20-day moving. You know, so basically saying that there's only 20% of the stocks right now above 20-day moving average. And you can see this is the low for 2024. This is the low for 2025, 2023, for 2022. Has been a pretty good indicator that the market is oversold and we are due for a bounce. Maybe not in a straight line back to 80, 90%, but at least, you know, some kind of a rebound back to 50% or 40%. So I like that chart. I think that is meaningful. Investor sentiment percentage, you know, what, you know, bulls and bears. You can see that in terms of how bearish people are, this is 2025 low, 2024 low, 2023 low. You know, you have to go back to 2022, right? In the kind of heighten of all the fear of when the Fed started raising rates in 2022, and we have a recession and steep pullback. Only at those levels we had such a negative sentiment in the market. So I like that chart as well. That's a good case for a reversal. What else? VIX, sharp rally VIX to all the way to 30 level, right? This is again probably 2025 highs. I think here briefly we reached this on the expiration in August. So I'm not sure if you can count that. You could. We did have a correction in August, but I think it's an extreme. You know, so 2023 high, 2024 high, 2022 we got close to 40, but from lower base. So I would say, from VIX perspective, we probably had a sharp move in VIX, not capitulation. I wouldn't call it capitulation, but VIX was a 30 above average volume, right? Also not extreme volume. It's not at 2022 volumes, right? Where we had these spikes during sell-offs, not even in April, March 23, when we had the default and smaller, you know, regional banks default. But, you know, elevated volume, but still not signs of capitulation. So that's bullish. I think the VIX reversal from backing down from 30 to 24, maybe another push down to 20 would be a good sign that the bottom is close to being in place. Bitcoin, also sharp pullback, reached this breakout, the 2022 high, right? This is the very popular chart, kind of a peak of the previous cycle highs. So back to November 21, 70,000, and we're very close, reached this level. So that's sitting at the support. QQQ is pretty far away from that cycle, December. Small caps are actually underperforming, continuing to underperforming, but QQQ, I mean, still pretty far away. So that's bullish, right? The Bitcoin as a proxy for risk taking also sold off meaningfully and staying at a very strong support level of 71,000. So those are the bull case that market is oversold, and probably at least this initial phase of sell-off is exhaustive at 10%, right? So what would be the bear case? Well, the bear case, well, nothing has changed, right? It doesn't look like Trump administration is going to change its mind, not anytime soon, right? We are coming to March expiration, just like if you follow my events on the Bob, welcome back. David, welcome. John, Lewis, Ray, welcome. So you can see that I always look at these expirations, right, and positioning. So if you look at gamma exposure and how people positioning, if you were in the February webinars, I did say that market is continuing to go on high, but one thing that I'm concerned is that during expiration, right, if you select April and March expiration, most of the gamma is concentrated in this front month's expiration. And same thing happened in February, right? The February, March 21st, February 21st, or third Friday of February, we had an expiration, all the positions were gone, and this is when the sell-off started, right? This is when the sell-off started. So now we're approaching similar situation where we are approaching the March expiration, right? And all of this gamma support levels will get expired, right? This is, if you look at the total puts and calls gamma, it's $10 billion. And if you're not familiar with options, the idea, this is where people buying puts, right? People buying puts and selling calls at certain strike prices. And if you collect all these options with the March 21st expiration, they have, total exposure of $10 billion. Sorry. $8 billion, close to $8 billion. And then once this expires next Friday, then in April, there's really not a lot of positioning right now in April expiration. And let's just make sure April. Yeah. So that's so that basically opens up a door for positive or negative surprise. And if you look at the history, you can probably see two scenarios, right? The possible scenario, right? We have that situation, similar situation in actually during COVID, right? During COVID, the same, almost timing was almost identical, right? February expiration, then there's negative news about, closing of the airports and, not allowing China to travel and Europe to travel to United States, and that triggered panic, right? But people knew about COVID before March, but because of the positioning, the negative news caused this precipitous drop, right? I'm not talking about the magnitude of the move, but I'm more drawing comparison to the timing of the move. It reached the bottom during March expiration, third week of March. Again, people got repositioned. Then there was the positive news, right? Just because there's an expiration doesn't mean that you're gonna move one way or the other. You need to have a trigger in terms of main catalyst. And back then, end of March, Powell came out and said, you know what? we're gonna stabilize the economy, we're gonna buy all the asset classes as much as we need to, right? There's no limit to the stimulus, and that gave confidence to the market, and the market rallied, rebounded. So that's one scenario, 2020. 2018, if you traded in 2018, similar setup, right? We had tariffs, right? Tariff war. The Trump administration started in 2016. Strong rally on mainly emphasizing deregulations and taxes, right? And net was positive for the economy. You have strong rally, then attention turned into tariffs, right? 2017, 2018, it started to the tariffs. And then we did have a pretty sharp pullback here, sorry. Starting October 2018. 2018 was pretty volatile, right? We have these sharp pullbacks, rebound. This is in China scare, was about 10%. Then we had a similar situation, 10% drop, right? On fear that Fed will have to raise interest rates, right, to battle inflation as a result of these tariffs. And then Powell came out and said, you know, in December, you know, the December expiration, no, we're gonna, instead of lowering interest rates, we're gonna raise interest rates to battle the inflation market was already on the edge, right? And then after that announcement, third Friday of December, another 10% pullback, 20% pullback, and you know, Powell came out and said, no, we're not gonna raise interest rates. And then the market has recovered. So those are the kind of drawing from the history are two cases scenario, and I think that's what's going to happen in April as well, end of March and April. We're either going to have, you know, looking at the gamma exposure, you can actually look at estimated move analysis, right? On one hand, we can reach 535 and 545 level, right? If you look at the weekly, I kind of did this analysis. I would say long term, the bull market is intact, right? We did break through this, the lows from October of 23. So we did break through this uptrend. But as long as we're above 480 long term, right? If you look at the monthly chart, we are still in a strong uptrend, right? If I zoom out to the monthly chart. All right, if each candlestick is 1 month, then as long as we're above 480, this long-term uptrend from, you know, last, you know, great financial crisis of 2008, you can see we had these sharp pullbacks, but we're still in long-term uptrend. And a lot of technicians would say 480 is the line in the sand. We got close to 50% drop, right? 545. An S&P would be 50% retracement, 50% retracement from all the gains we've achieved since January of 22 or January of 24, right? So we give up 50% of the gains. And you can see from positioning level, you know, 545, Fibonacci retracement, 530. People are already hedging these levels, right? 540, 535, one standard deviation. But if you look through all the strikes, right? Well, there's not much positioning, you know, the last one is 530 strike. And then 500, you know, all the way to 450. There's no positioning, there's no high gamma concentration, right? So you have 530, then 520, and then that 480 strike, right? There are a lot of people already buying 480 puts. Why are they buying these 480 puts in large quantities? Well, these are the bears. These are the bears that says, listen, we're going down to 480, 450, because, you know, next move is to the downside. And there's already a lot of, so that, I mean, that's obviously 2 standard deviation move. 1 standard deviation move is about 530, right? This is probably the highest strike right now, 530 in terms of position. So from bearish perspective, even though we're oversold basically on any technical levels that you can find out, but if there's no new information in the market, then potentially we could reach, if we break through the 530, we're not that far away, we're at 545, I think. So, you know, if the 530 level doesn't hold, that means we do open up the door to 480. And that's similar to 2018, is exactly 20% drop, right? Almost exactly 20% drop. So those are the different scenarios that can happen based on the expiration and repositioning, and then based on the, you know, market conditions. So, I mean, I'm not going to draw extreme, you know, extreme cases because 2 sigma moves are rare. Let's just concentrate more on the 1 sigma move. So basically 1 sigma move based on the option data implies 530 strike, right? So on one extreme, we can reach 530 level. We already broke through 565, which is July high in S&P. Basically, the next level is, according to position, 530, 50% retracement, or August lows would be 510. I'm gonna put down 5, since it's 1 standard deviation. Let's go with 530. 530, and you have some support here, so it makes sense. Okay, so 530, and on the upside, I forgot what was on the upside. 530, large position at this strike, 580. So you do have 580 and 590, 580, 590. Okay, so one extreme, we're going back to 590, right? This was the breakdown of 2025. The other extreme is 530, right? And then you have 2 extremes, you know. Scenario number 1, we're moving 2 sigma move, we're reclaiming all-time highs, or maybe even higher, right? Going into, you know, April. Usually from bull perspective, April, May are strong months. So if, let's say, Trump, the new administration actually backs off from the tariffs, then you could get scenario number 1. Scenario number 2, we're trading in the range, nothing is changing, right? Tit for tat, up and down, we're trading 590, between 590 and 530, right? That's scenario number 2. Scenario number 3, kind of, if we break the 530, then 2 standard deviation, and we're revisiting at least August lows of 2024, which is 510, 500 level, right? Where a lot of positioning, a lot of historical support and resistance at this level. So those are the 3 scenarios. Scenario number 1, we're reclaiming all-time highs, and scenario number 2, nothing changes, tit for tat, tariffs on, tariffs off. Powell is in wait-and-see mode in terms of effect of these tariffs on the economy. And then we're just between 590 and 530. You know, we have the wave A. Usually these sell-offs come in 3 waves, right? A, B, C. Right, so you have A, maybe A is coming to an end. We'll see it PPI data tomorrow. Then wave B, and then wave C, right? So are we going to, so that's scenario number 2 and scenario number 3. Why is this important? Why do we need to go through these exercises, whether you're a short-term trader, medium-term trader, or long-term trader? Because it's all about positioning, right? From Yellow Tunnel, I started Yellow Tunnel with the idea that trading psychology is important, right? And not only it is important to look at the chart patterns and predict, you know, what can happen, or look at the different scenarios of what can happen, but also to predict how you will react, right? Because if you said 1, how will you react if the scenario 3 occurs? If you said 3, how will you react if scenario 1 occurs, right? In terms of position size and number of positioning. So the most important is to predict your own behavior and your own actions based on, you know, market conditions, what market will do, and that's difficult, right? You have to learn about yourself, especially if you haven't been through these pullbacks and these corrections. And then, you know, it's, if you don't go through these exercises, you cannot find the right position size, right? This way, if let's say I'm bullish, and I think market at least is going to get to 590, and we're at 560, right, plus 30 points, right, versus minus 30 points, then you can say, okay, this is my stop loss, 530 or 510, right? And then, you know, how much cash do I have? And then, you know, if you're buying at 558, you probably want to, and you're bullish, you probably want to buy at 530 or 520 as well, right? So But to determine the position size, how many shares you're willing to invest into support your scenario number one, unless you think about 530, right, or 510 support, you don't really know where the support and resistance are. All right, so how many of you say scenario number one? Yeah, John, 1, 2, 3 standard deviation, this is based on implied volatility. So when I look at the spiders and exposure, this is one kind of close to what, think about one standard deviation. Basically, roughly 70% of the time, stock will trade in these levels, right? So you can see that between April and March expiration, we'll be trading between 575 and 580, or between 530 and 545. Those are the two, one sigma move, right? And this is all kind of back to statistics classes. Most of the time, we're just trading here. But again, you're right. If implied volatility expands, then this could change dramatically. Okay, so how many of you say one? Bob, David, John, Lewis, Ray? How many of you say Vlad, one? This is just overreaction to Trump. Trump is pro-business. He's gonna, decrease regulations. He's gonna, cut the tariffs. He's gonna, find a peaceful agreement between Russia, Ukraine, and put Canada and Europe to their knees. So we're going to one. All right. How many of you say no? Trump, this is different from 2016. He's not going to back down anytime soon. This, finding these tariffs, finding the right policies, it's going to take time. It could take a year, it could take 2 years, we're just going to trade in this range. And scenario number 3, something's going to get break in the economy, right? Right now, we still have healthy economy, although it's cooling. But if the uncertainty persists and companies are going to hold off on their investments or hiring people, and you have uptick in unemployment and downtick in employment in capital investment, then you have scenario number 3. All right, rate 2. And then employment due to Doge will impact as well. All right, so the market is going to be volatile, right? Some of you said 2, nobody said 3. Lewis, not 2. So I'm going to stick with 2, right? I don't think there'll be a lot of new information. I think market is oversold, but we've seen today CPI data came in better than expected. Unemployment last week came in better than expected. Market is not rebounding on these, what I would say, positive news. It's still considered to be a weak rebound, even though CPI data is down. But because, tariffs have not affected the inflation yet. They're not in place. We're just starting. So since we don't know what's going to happen in the next couple of months, people are still waiting. So I agree. I think scenario 2 is more likely to occur, right? Where we would probably trade, 15% correction, 530, and somewhere 580, 590 range for the next couple of months until the tariffs get resolved and until the Fed will make up their mind in terms of interest rate. So that's Ray. Thank you. Scenario 3 might happen too. I mean, just like we had in 2018, all it takes is one kind of another big negative news. I don't know what it is. Maybe it's 50% on Canada tariffs, like Trump said yesterday. Even though he said 50%, market did not fall apart, right? Because people kind of already getting used to his kind of intraday announcements, and at some point, market is going to be immune to them. So when we don't sell off on bad news, that's good. When we don't rally on good news, that's also not good. So that's kind of why you see market as kind of wait and see mode. We'll see tomorrow is the PPI data, producer price index. Maybe if producer price index is also lower like CPI, then maybe there is more room to this rebound, right? If it's obviously worse than expected, then, or retail data, I think, coming out as well, then, you know, pullback starts again. So how do we help at Yellow Tunnel? So again, we have models, predictions that can help you identify support and resistance level. You know, for today, 547 support, 560 is overhead resistance. We closed exactly at 560. So these predictions get posted the night before the session started. So model did a good job showing you 560. You might want to consider, you know, trimming your positions. At the 547, you want to consider going long. 10-day forecast is 500. Model is turning very aggressively bearish because it doesn't see any support till 500, and you can kind of see it in this chart as well. That we could drop to 500 pretty quickly, especially if we dip below 545. Right, this is the, I think this week's low is 545. So if we drop below 545, which is not that far away, you know, then at that point, 500 might not be so out of this world, right? 2 more weeks and we could be quickly another 10% drop or 5% drop. We do, you can analyze any stocks and, you know, some of these, you can also see my own orders and positions. So today I put in 550, 540 put spread to hedge my long positions. Right, so this is an example where if we do drop below 550, right, we could quickly drop 540, 530, so it makes sense to hedge. So I did put 550, 540 put spread, risking $2.80. If you want to see longer term signals, we have weekly power trader, right? That basically says, listen, if the market is oversold, what else makes sense to buy? Obviously, Bank of America, Broadcom, BSX, all of these stocks are extremely oversold, and longer term trend is still intact, right? It's still intact that it can continue going higher. So if you're looking for signals or ideas, then you can find them here. Dynamic power trader is where I trade both stock and options, right? So you can see different positions. You know, I position Broadcom, Citigroup, Amazon, General Electric, Capital Financial, and hedging some of these positions. So that's dynamic power trade. It's a combination of both stock and option trades, right? So you can see spiders. I closed March General Electric position, and you know, I'm still holding April long position. So stock and options, you can find all these trades inside of the dynamic power trader. Earnings power trader, I didn't do the trade today, but you can see a trade like Adobe. It's an expensive stock. It had earnings today, but same thing. I did similar analysis, one standard deviation, 400, and you know, I think last time I checked, Adobe is around 420, 415, approaching 400. So I did calendar spread. I talked about calendar spread. Sometimes I do diagonal. We went through these examples, right, of calendar spreads on Adobe and selecting the strike prices. So that's part of the earnings power trader. You do have live trading room, you know, morning and closing, where you can also participate. Finally, if you're just looking for trade ideas, but only stock trades, you can look at the profit accelerator, right? So you can see I'm long Amazon, long Capital One Financial, Amgen, and others. So those are different services that you can consider participating, right? Aggressive power trading, weekly power trading mostly is just signals, and then these are the portfolios that I'm managing. You can always go to dashboard. It shows you basically our getting started guide, our webinars. You know, I encourage you to schedule one-on-one dedicated support consultation, blog, and you know, we have a blog every Sunday, and then 5-minute video every Wednesday. And then if you're looking for paid subscription, then you can look through more details, and you know, you can look at my webinar here. that it describes each of these services that you can participate in. Ray Jackson, if so, what do you recommend? How should we trade the range? Market. What about trader who can't watch market all day? Which service you recommend? If you can't watch the market all day, I would recommend Dynamic Power Trader. The strategies that work the best, from my experience, especially if you trade in the range, you have to be long and short the market at the same time. How do you be long and short at the same time? This is an example where, on the long side, I have Broadcom because I think it had better than expected earnings, right? And it's over, the sell-off is overdone, right? And it has a nice bounce off of 200-day moving average. It held July highs, unlike QQQ and other semiconductors. So stronger stock like Broadcom, or I have General Electric, then I'm long, right? I'm long these stocks because they're better than most of the stocks, and there were signals that the model generated. But for every long, you want to have a short, right? And in this example, I think you can just short the market, spiders, right? Spiders broke through 565. As long as we're below that 565, you don't know where the bottom is, right? I mean, we had 3 days we didn't make low. I like that, but we need a break above 565, this week or next, right? Get above 200-day moving average. And if we can't do that, if we are unable to do that, then it's just a pattern of lower lows. So then you can buy, spiders put spread, QQQ put spread, or we do have short signals as well that the models generate. Right, let me know if that answers your questions. All right, Danny, welcome. John, Louis, Peter, Ray. Any other questions? So if market stays uncertainty and volatile trading in the range-bound trading is very important. If you have a larger portfolio, my favorite strategy is protection strategies, right? So where you both long and short the market, mirrored put, right? If you I analyzed NVIDIA, right? Everybody wants to trade NVIDIA. NVIDIA sold off. If the market rallies, then it's not going to do it without NVIDIA, right? And you can look at some of the positioning, right? So you do have a pretty strong position at 110, right? Positioning. So, okay, if you think that 110 is well supported and NVIDIA is going to bounce, right? Just like Broadcom. But, you don't know exactly, if this is the bottom, then you do mirrored puts, right? You basically say, okay, 410 is the strike, it's going to hold it. Maybe go into May. I mean, April and May is probably going to be, March is going to be volatile. April 17 might not be enough time, but May, maybe it's enough time, right? And then you do mirrored put, right? So you spend in $16 on the 410 put, right? So you know that. Sorry, this is Adobe. Here's NVIDIA. NVIDIA, let's go into May. And large position at 110 strike, okay? So you can buy 110 put for $7, right? You can buy 110 put for $7. That means 5 drop, and then your maximum loss is $12.89. So that's kind of, where you have the downside, exactly what your maximum loss is, right? $12.89, the cost of the put, and then the difference, $5. So you down 12, your maximum loss is $1,000, $1,200, but you have unlimited gains, right? If it goes back to all-time highs, 150, from one, then you have $35 gain, right? 3,500. So this is where you long and short the market. You can, if you don't want to spend 1289, you can buy a put spread, right? You can buy a long put, but sell put against this. And same thing goes for collars, right? Protective collars. You don't have to do it all at once. When the market is overbought, right? You can say same thing. Maybe like, yeah. So you buy 110 put, and let's say you sell in 125 call. So again, if as the Nvidia approaches, 125, 130, you might want to just sell the call, right? Because you don't think it's going to break out, and you know it's not going back to all-time, or you don't think it's going to go to all-time highs, right? So then, as the Nvidia rallies and the market gets to overbought levels, right, that wave B, then you sell 130 call, and if it drops, or sell call and buy put, right? And then hedge yourself. When the market is volatile, usually I just get into merit put, and when I do see the market is overbought and nothing has changed, then I would sell the call, kind of leg into protective collars. So protective collars, merit puts are great strategies, right? You have merit calls on the downside, right? You can sell short the stock and buy a call to hedge. So merit puts, merit calls are very popular strategies, but it requires capital, right? Because 100 shares of Nvidia is $11,000, and if you have only $10,000 in your portfolio, well, you can't really do it. Well, then you have to do spreads, right? Then instead of buying 100 shares of stock and spending $11,000, you can buy, 115 call, right? You can do 110, 130 call spread that looks very similar to protective collar. Any questions? Right, never heard of merit put. We'll look at that up. Yeah, merit put, merit calls in a volatile environment. I think that's the best approach. You can express merit puts. You think the market is going higher. Merit calls, you think it's going lower, but you're hedged, right? You know what your downside risk is. And it's very similar to collars, very similar to spreads, right? These are all the strategies that are market neutral. Obviously, there is other ones, market neutral strategies like condors, right? Horizontal spreads is also popular, but this is something that I would consider. John, where in the bar chart you navigate? Usually you type in a symbol, right? When you go to barchart.com. I know sometimes it's difficult to find these things. I agree. I already told barchart to look into this, but you type in NVIDIA, when you type in individual symbol, then it gives you these choices, right? And it gives you the gamma exposure and, protective strategies and all that. So type in a symbol, then you get into individual, options data. All right, any other questions? All right, you were awesome. Danny, John, Luis, Peter, Ray, and everybody else. Michael, Steve, thank you for participating. Take advantage of one of our services. You get access to live trading room. So you have me, Vlad. My background is technology and computer science, and I'm a CTO of several fintech companies, work at hedge funds, broker dealer, building a lot of AI models. So my background is more technical, but I am also a trader. And then we have Keith, who is the next option market maker and worked on many hedge funds, and he's a professional trader. So between two of us participating in live trading rooms, you can get a lot of exposure. So take advantage of one of these services. I would start with Dynamic Power Trader because you get stock and options, and you have live trading room, and you can follow our trades. All right. Thank you, John. Thank you. I pick up golden nuggets, right? And just like John, been a client of ours. John, how long? I mean, probably 5 years, maybe 10 years, probably more than 10 years actually. And I appreciate you. 15 years. Thank you. 15 years. So John, you know, John and I go back, I think, to CBOE days, right, when we had that webinar at CBO. Ray, yes. So check our site. We do give 30-day money-back guarantee. Try any of these services, and you know, you get free content, free education. We stand behind our products, and we understand this is not a solution for everybody. So if this is not something you think you benefit or doesn't fit your trading style, great. We'll give you, you know, there's 30-day money-back guarantee on these 5 services. So try them out. Live meeting in Chicago, yeah, Option Pit, I remember that, yeah. Okay, perfect, I remember I was doing the presentation there. Wow, 15 years, thank you, John, this is awesome. All right, guys, thank you very much, have a great day, and I will see you shortly, thank you.